So why growth stocks are more sensitive to inflationary pressures than value stocks? Well, let me show you. To evaluate a company, we usually use the system called the DCF, discounted cash flow. Basically, there's two elements here if you notice, the discount and the cash flow. Essentially what we're doing, we're discounting future cash flows to present value today. And if that sounds like Chinese to you, hang on a second. I'm going to explain to you in a second what it means. Essentially, every business is worth whatever amount of money it can generate. Now, I hate to agree with Kevin O'Leary here, but that's essentially at the core of it, what it means. Now, with growth, you have to be a little bit more patient, but with value, you're seeing the cash right now. But on the other hand, on the flip side, with growth, you have way more potential in the future than a value stock typically, right? So here's the thing. If I look at year 1, year 2, year 3, year 4, and year 5, for some reason 4 didn't register. Now I'm going to generate money here, 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 and in year 5. Let's just assume it's a crazy growth pattern. On the other hand, let's compare it to a classic value stock. I'm going to generate X here, 1.1X here, 1.2 maybe X here, maybe 1.3X here, and so forth. So you can see that the level of growth is completely different. Now, on the one hand, this company at the bottom, this is almost guaranteed money. Like company like Coca-Cola or Dairy Queen or any of these sort of companies Warren Buffett invests in, these are pretty much guaranteed, but they're not going to get you out of the stratosphere. This isn't Tesla money, right? This isn't going to explode. On the other hand, here you have much more risk, but the reward, the payoff, the potential, the gamble is much bigger. So the only question is, what's your philosophy here? But here's the thing. Whenever you choose to invest in this sort of stock, the growth, here's what happens. Now, let me tell you a little story. Let's assume that I owe you money. I ran over you with my tractor and I was drunk, and then the court ruled that I have to pay you over the next 10 years, whatever amount of money just to as restitutions, right? So let's say I owe you $100,000 each year for 10 years. So totally $1 million to repay for running you over. So let me show you how it looks like. So basically we have year 1. Sorry about that. It doesn't register for some reason. Let's try it again. Year 1, year 10. Okay. So there's 100K every year for 10 years. Total of 1 cool million. Now, what if I have money and I don't need to pay 100 every year? What if I come to you and say, hey, listen, I got an offer for you that you can't refuse. Only I don't do that in a kind of, Godfather way. And here's my offer. I'm going to give you a lump sum. Instead of paying you 100,000 for 10 years, I'm going to give you a whole lot of money today. Kind of like the J.J. Wentworth, I want my money now thing. You remember that ad in television? I'm going to give you actual lump sum today. Only question is how much? How much are we willing to take to get this thing to go away? Instead of $1 million, what would be the amount that you're going to be willing to take today to settle this? Because I can still pay you 100 every year for 10 years and pay you $1 million, but if you're willing to take a little bit less, I'm going to reward you. I'm going to give you a lump sum right now, and I'm going to really make it nice for you. So the question is how much you're willing to take. Now, here's the thing. Let's say that this is me. Let's say that this is you, okay? Okay, so you're thinking to yourself, well, I can take probably, $800,000, and I could put it in the bank and get interest. And over the 10 years that I'm going to put it in the bank and get interest payments for, I'm probably going to make $1 million. And I'm using 800 just as an example. It can be any sort of amount, but that would depend on one thing. I guess you understood it by now. This would depend on what's the interest rate. The higher the interest rate is, the less money I'm willing to take, because I'm going to be able to make it back through putting in the bank and getting interest. So it would really depend. My answer would really depend, or would be different. Let's say if the interest rate was 10%, or if the interest rate was 0%, right? If the interest rate is 0%, like it is today, then I'm going to tell you, listen, buddy, nice offer, but I ain't taking anything below $1 million because I really can't do nothing with 700 or 800,000, not even with 900,000. There's zero interest rate on the market. It's not going to help me. So just pay me the $1 million because the rate is zero. But if the rate is 10%, right? So you're going to say, well, if you'll give me 900 and I'll make another 90, that pretty much puts me at $1 million, but I'm getting it lump sum today, and it also eliminates a lot of risk of waiting for 10 years. I can enjoy the money today. So I'll probably take 900 here, and I'll take 1 million here. Why does it have to do with our question about inflation and growth stocks? Well, let me explain. This little exercise we just did with the two human beings right here is the same thing that every company does with its valuation. When we value companies for the future, this is exactly what we're looking at. We're looking at the future and how much cash flow is going to be generated. Imagine that every single piece of cash flow that we're generating in the future is actually these little payments. Like, for example, I'll show you like here, this little percent right here, whatever the bank is going to pay me, is exactly what we're looking at, what the Fed is going to do with interest rates. Exactly. This is the same idea. So instead of using these fictional characters and this fictional example of a drunken tractor driver, I don't know if you could say tractor driver, operator, let's just use an actual example. Let's keep this little sad me in the corner because I think he looks nice. Yep, let's keep you on. We took away one leg. He lost his leg in the tractor accident, I guess. So company year 1, year 2, year 3, year 4, year 5. Remember that? And you remember how I showed you X, 2X, 3X, 4X, and then a 5X. Now, basically, this is 2022. So this one is basically this amount, whatever we make in 2022, it's worth to us whatever it is. But this 2X, we have to bring it back 1 year. 3X, 2 years. 4X, 3 years. And 5X, 4 years. So every one of these amounts have to be brought back to today. In the same example I just showed you with the two human beings trying to figure out how much money they're willing to take today to alleviate the future payments. But these little 2X, 3X, 4X, 5X numbers that are going back to 2022, from 2023, 4, 5, and 6 and onwards, the amount they're going to be discounted by, how much it's going to cost to bring them back, depends on the interest rate. And the higher the interest rate is, the more chunk you're going to be willing to take away to buy this company today at a lower price. It's the same thing with like the two human beings. So if the interest rate is high, this 2X right here becomes 1.5X today. This 3X becomes 2X. You see what I'm doing here? So basically all of the future cash flows are becoming less valuable today. And by the way, this is exactly why this thing is called the discounted cash flow. So the cash flows are discounted, and the rate of discount is the interest rate in the market. Essentially, it's actually called the weighted average cost of capital, WACC, but it's comprised from, I guess, expected returns and whatnot, but also the cost of debt. And the cost of debt is a really integral part of that calculation. So when you have interest rates at zero, really drives valuations up because all of these amounts stay 2X, 3X, 4X, they all stay 2X, 3X, 4X because the interest rate is zero. But when there's an inflationary period and the Fed is hawkish and basically talking about raising interest rates, the weighted average cost of capital goes up and the rate of discount in the discount cash flow, the DCF, goes up, bringing down the valuation. So the more you have 2X, 3X, 4X, 5X, the more you're impacted. But here's the secret. Every single company in the world is going to get hit by a reduction in its valuation through DCF if interest rates goes up. But the companies with the most amount of value in year 2, 3, 4, 5, and 6 are going to be affected much more heavily than a company with 1.1, 1.2, 1.3, and so forth and so forth. And that is exactly in 5 minutes why these other companies will be hit the most when interest rates goes up to handle inflation. And it's not really rocket science. Simple as that. Don't let them bullshit you around.